owning some small caps which would have seen a drawdown in this last 2-3 months, right? Some maybe 20%, some maybe 30, some maybe 50, what have you, right?
Yeah.
How do you decide where is it that you get out of?
Yeah.
And how do you decide, let me stay put? Because when it falls 30, 40, 50%, you are scared obviously about whether the story is gone wrong or is it just a valuation correction or everything is going down.
Yeah.
So how do you decide?
Yeah, so I think one of the big mental reset that one needs to do at this point in time is detach yourself from the existing portfolio. Think as if I am restarting, building a portfolio. I have new money, I need to build up a portfolio now. And see what kind of decisions will you take then. Right? Unfortunately, what happens is that because of the baggage of you having taken maybe wrong decisions, or just because of market fall, things have corrected, you get clouded by a lot of those decision confusing facts, right? So once you remove that, build your completely new portfolio and then see, is it the same as what you have now? If there is a big difference, just change that, just make that transition, because after all, your returns going forward will be based on today's valuation, based on today's optimal portfolio. And you need to build the optimal portfolio now without the baggage of having your old portfolio.
But it's an easier said than done thing. Are you able to do it?
I mean, it's just that you need, see, sometimes fund managers do have restrictions of getting out. Sometimes you just can't get out, right? Because by getting out, you probably will have 10% more fall or 15% more fall in the stock, right? So that becomes a hurdle. But for most of the investors, that's not a hurdle at all, right? So it's much easier for, a retail investor to do this adjustment, right? But at any point in time, even as a fund manager, I need to think, my portfolio is what it is, right? There will be some companies which maybe were highly valued. I may not be comfortable. I really love the businesses, but I don't like the valuation. A lot of those companies actually have come back to a very comfortable valuation. So you may have cash or may not have cash. The cash decisions would be very different. You may go for attractive, but I think you need to think about the same thing even here, that you think that whatever you have in your portfolio is an opportunity cost for you, right? You can easily replace that with something that you like, So if something else which is outside of your portfolio is much more attractive, you replace it. This is a time to swap. First of all, if you're in loss, this is a time where you can book losses, save paying taxes, and at the same time get something which is really attractive. So if you're aware of this fact, at least you will consider these factors for decision making, and it would help, because most investors would have lost value in their portfolio. They may not have cash, right? And it's easier for people who were lucky enough to keep cash. But don't bog yourself down with that. Whatever is in your hand, make the best optimal portfolio out of it, and then you'll be shocked. This can continue for sometimes 8 months, 9 months, sometimes a year, 2 years. But when things rebound, you will make up for not only the lost, portfolio value, but even make up really good returns in a matter of 4 or 5 months. It has happened multiple times. I mean, during 2009 fall, small caps had fallen by 70%. And in the next 14 months, the markets were up, the small cap was up 3.5x. That means they recovered entire fall. I mean, such a massive fall. This time it's, the fall is like 1/3 of that.
Yeah, exactly.
Right, 1/3. So it doesn't take much time to recover. But more importantly, make sure that the companies you have are the ones which will recover, because there will be many companies, in your portfolio, which may be a lot of story stocks, which would be much more cyclical, where there was a story, and many of the time in the long run do not do well. But, like I had made a presentation of how cyclical companies, in post-COVID, in the next 4 years, on an average, have gone up 10x. Whereas good quality companies have gone up less than 2x during those 4 years. There is a huge gap. Now, if you expect that these cyclical companies will continue to, if they have fallen by 50%, they'll quickly recover. That's like living in a fool's paradise.
So you believe that change will happen now?
That change will happen. But make sure that the portfolio that you have now is made out of companies which are longer term structural stories, where valuation has become really attractive. Forget about the fall in your existing stocks. Some of them will never recover. The breadth of this rise was so large that many of those stocks, I would say, sometimes 70, 80% of the stocks will never see the recent highs in many years to come. Right? But if you are just looking for 15, 20 stocks, make sure that whatever stocks you have in your portfolio, have that high probability that they will, in 5 years, they'll be much higher than the peak that you saw in the recent past.
And the simplest yardstick is possibility of higher sales growth, right? Because that was one of the key thing.
Possibly higher sales growth as well as possibility of sustainable ROE.
Both.
Because cyclical companies will not have sustainable ROEs. And they will have, generally cyclical ROE.
So you would have played cyclical companies from 21 to 24 if you had played, but you are also out of them. You are now going for the sustainable ROE businesses.
Yeah, see, one-off you can take a tactical opportunity, but majority of your portfolio, generally should not be. It's a high risk, high reward kind of a game. What we look for is high risk.